Hi everyone, welcome to Momentum Lab. This is Mani Deepak. In today's video, we're picking a very special topic. It's an interesting and sophisticated product that was very recently launched. It's called the Specialized Investment Fund, in short SIF. So I'm going to take you through the basics of what an SIF is. Why is this product launched in the first place? What is the need for it? How can one invest in this product? What are the different categories that are available? And lastly, we will also touch upon who does this appeal to, what kind of investors should start thinking about this in their investment portfolios. So let's just get right into it. Before I get into what SIFs are, I wanted to take a step back and take you through what are the different avenues does an Indian investor have under the SEBI framework through a managed structure. So what do I mean by a managed structure? Essentially, you give the money to someone else to let them take their own calls on which stock to pick, which debt to choose, whether to have international exposure or not, whether to use derivatives or not, which commodity to pick, and what position size, right? So all these calls are taken by a dedicated fund manager in a managed structure. So far, we had three options. First is a very familiar mutual fund. Number two is your portfolio management service, in short PMS. And number three is alternate investment fund, in short AIF. Now, if you look at the minimum investment criteria for a mutual fund, it probably ranges between 100 to 500 rupees, depending on the scheme that you choose. In a portfolio management service, this minimum investment is upwards of 50 lakhs. So it should be at least 50 lakh rupees. Whereas in an AIF, the minimum investment is at least 1 crore rupees. Now, if you look at the spectrum of minimum investment, it starts from 100 to 500 rupees to almost 1 crore rupees. If you look at it, there is a huge gap between a mutual fund and a PMS with a minimum investment from 100 to 500 rupees to almost 50 lakh rupees. So there comes your new category, or maybe I should call it a new industry, which is SIF, with a minimum investment criterion of 10 lakh rupees. While these products that we just talked about are different in terms of the minimum investment criteria, there's another aspect that differentiates these products, which is the usage of derivatives and leverage. So leverage allows you to additionally borrow money for investments. So if I just look at derivatives, in a mutual fund, derivatives can be only used for hedging. You cannot take any unhedged exposure in derivatives. Unhedged exposure is also called as a naked exposure. In a PMS, again, similar to mutual funds, derivatives are primarily used for hedging. Whereas in an AIF, 100% of the fund can be used for an unhedged exposure. So here is where SIF is different. SEBI has allowed up to 25% exposure into unhedged territory. That means a fund can take up to 25% naked shorts exposure. So which essentially means the upside could be very high, but that also comes with appropriate risk. Given the exposure to unhedged territory of up to 25%, SIFs could sound very risky, but that may not be true. It totally depends on the scheme, totally depends on the fund house, on how they want to position it. They could actually use this flexibility of using derivatives to hedge short in a way that the upside is limited and the downside is capped. So that allows the investor to earn a stable premium over time with very low volatility. So you need to carefully understand the scheme before you invest into SIFs. The second part is the leverage. In a mutual fund, obviously, there is no leverage allowed. In a PMS as well, there is no leverage allowed. Same is with SIFs. But in an AIF, you can take 100% leverage to double down on the bets. So that's one key differentiator between AIF and any of the other products in terms of leverage. By now, I believe you are very clear that SIF is not another mutual fund. If you look at the taxation for a mutual fund, there is no tax on any churn that happens within the fund. So that means if a mutual fund is following a strategy and within that strategy, they have to sell X stocks and buy Y stocks, in this process of selling, they don't accrue any taxes, be it short term or long term, as long as the investor is not redeeming that fund. Only when the investor redeems the fund, you have a short-term capital gain of 20% and a long-term capital gain of 12.5%. Whereas for a PMS, any churn within that fund is taxed. So even if you sell some of the stocks and reinvest that money into another set of stocks, you still are taxed. While this is not a case for mutual fund. And if you look at AIF, the taxes are even higher because, like a mutual fund investor, you have a 12.5% long-term capital gains and 20% short-term capital gains. And in addition, any income that is generated through derivatives is classified as business income and is taxed at a rate of 30%. So on an average, an AIF could be taxed at 30 to 40%. But if you look at an SIF is taxed very similarly like a mutual fund, depending on the category it falls. We will talk about what categories these are, how are they different from the mutual fund structure. Now let's discuss about why is such a product introduced, right? So we already discussed about the gap that we've observed between a mutual fund and a PMS in terms of minimum investment, right? So the gap is huge. So it makes sense to introduce a new product in this white space. So that's how SIF is very well placed with a 10 lakh investment between a mutual fund and a PMS. Now there are two more data points I want to share with you, which probably suggests why an SIF is introduced. So one is that nearly 92 lakh investors as per CAMS hold more than 50 lakh mutual fund portfolio, yet only 3.5 lakh investors have invested in PMS and AIF. So that gap is nearly 26 times. So this makes investors with more than 50 lakh portfolios to actually think about this product. The second aspect is about the growing losses in the F&O space. It's a fairly known fact that there are about 1 crore F&O traders, and nearly 90% of these traders lose money in the F&O space. So SEBI clearly wants to allow such traders to use the help of an expert fund manager to manage their interests in F&O trades. So another aspect that differentiates an SIF product is the way they are purchased and redeemed. So purchase can be done on any day, but redemption has certain restrictions. So depending on the fund category it belongs to, you could only redeem on specific days within a week. So it could be twice twice a week. You have an option to redeem. It could be once in 2 weeks. So this is where it is very different from a mutual fund. So an SIF, depending on the fund house, you could have different redemption criteria. So just make sure you're reading the criteria before you invest. Again, in terms of exit load as well, they're very different. So far, the funds that have been launched, I see a 1% in some cases for one fund. There is a 1% exit load if redeemed in less than 15 days, but anything after that is 0% exit load. For some cases, it is like a slab structure. You redeem in less than 15 days, it is 0.5%. Between 15 days to a month, it is 0.25%. Anything beyond that is no exit load. So it looks quite different from that perspective. So what are the different categories that we have in the SIF space? So there are three different categories that have been defined so far. The first one is the equity category. So within equity space, there are three different categories: the equity long short fund, equity X top 100 long short fund, which essentially means you leave the top 100 stocks. You do a long short strategy on the mid and small cap segment, essentially. Then you have a sector rotation long short fund, where the fund needs to ensure that they have a mandatory short on all stocks in the sector. The second set of strategy is the hybrid strategies. So the first category is active asset allocator long short fund, which is an interval based fund. So that means you cannot exit whenever you want to. The second category in this area within the hybrid area is hybrid long short fund. Interestingly, most of the schemes that were launched so far are coming from this category, the hybrid long short fund. Here you have about 25 to 75% allocation in equity or debt, and about 0 to 20% in REITs and InvITs. Also, you can take unhedged exposure of 0 to 25% in both equity and debt. Now within debt, there are two categories. So the debt long short fund, and the second one is the sectoral debt long short fund. Again, here there is need to be a mandatory short on all instruments in the sector. So these are interval based as well. So totally there are about 7 categories that were introduced so far in the SIF space, and we'll have to wait and see if there's going to be more categories coming up in this space, or there's going to be more consolidation coming up, similar to what happened in the mutual fund space. So if you look at the kind of options that a fund manager would have for an SIF is huge. So they can look at covered calls, straddles, spreads, pair trading, collars, protective puts. So the number of strategies that they have in hand with this new flexibility is huge. And obviously, SEBI has introduced this minimum criterion of 10 lakh rupees because they want to ensure that people are not just investing their money into this, but also are trying to understand what this product is, what can it do, what are the different aspects of it, what kind of derivatives are we talking about. So thank you for watching this video. In the next video, we'll dive deep further into SIFs. We'll pick one of the schemes as an example, try and understand how do they operate, what are the different options do they have, look at the different schemes and go into further detail. So looking forward to talk about it in the next video. Thank you so much.